A happy and most prosperous New Year's to all of our friends and viewers at StockCharts.com. This is Larry Williams, and I'd like to give you a little bit of my view of what I think is going to happen in 2021 and why I think it's going to happen. I really want to give you an education here into what can help us understand the future of the markets. And I love this quote from, of all people, Jimmy Carter. We cannot know the mystery of the future. Well, Jimmy Carter probably was the most economic illiterate president that we have. Maybe we can really know the mystery of the future. I recall those times when we had 18% interest rates and runaway inflation during Jimmy Carter's regime as president. Can we know the mystery of the future? Well, we can't know all of it, I don't think, but we can certainly know a lot of it. Here is the red line, the actual forecast that was sent to my forecast readers in December 2019. And now you can see the black line on top of it, the way stocks actually traded during the year, pretty much like the forecast said that it would. In other words, we can get a glimpse of the future. Mark Twain said it best: the future doesn't always look exactly like the past, but it often rhymes. And what a great statement from probably America's best novelist. Here is our utilities forecast also for 2020. The red line is a forecast done a year in advance. The black line is what actually happened. So I think it's possible to get a view of the future. And I'd like to show you how I think we can do that, what tools will help us. To know the future, you need to know what drives the future. And clearly, Federal Reserve policy drives the future. Interest rates are huge in stock prices, as is the cost of energy. I'm going to give you some forecasts based on those things. And of course, valuations, which really bothers me right now. The market are very high valuation levels. And cycles, I think, can be really helpful to give us a turning point coming up this coming year. And maybe above all, just pure raw emotions of the marketplace. Remember in March when we got so bullish here on StockCharts.com, everyone was panicking and selling. It was just raw emotion that created a market bottom. So raw emotions at the immediate time they're happening can be very predictive for us. Well, I'd like to talk about the Federal Reserve. There's a mandate from Congress to the Federal Reserve for three things: maximum employment, stable prices, and moderate long-term interest rates. That's their goal from the from Congress for the Federal Reserve. And the reality is, in the last 60 years, I've seen them save or regulate the economy and the stock market. A lot of people don't like the Fed. I'm going to talk about that in just a moment. But in retrospect, if you go back for the last 60 or 70 years, go back to about 1945, they have not done a bad job. I know. The Federal Reserve is no more federal than FedEx. I've read The Creature from Jekyll Island. I read The Secrets of the Temple. I know the Fed has never been audited. I know all that stuff about the Fed. But nonetheless, I think I've got to hand it to these guys. They've done a pretty doggone good job. We have not had a severe market crash like 1929. We have not had any extended recessions or depressions like we saw in 1930s and 1940s. Why? Luck of the draw? Maybe. I don't think so, though. I think it's because the way the Federal Reserve has handled monetary policy. So I used to have those conspiratorial beliefs about the Federal Reserve System. I love this quote: in a world full of manipulation, as half-truths, lies, the conspiracy theory is often a safer bet than the official story. Well, I never really bought into the official story about the Federal Reserve. I thought they were probably rigging the deck and all that stuff, but eventually, maybe in 1985, 86, I've been very involved in politics. I saw the Fed the way most people do, a conspiratorial group. I don't any longer. It's a pity youth is wasted on the young. Some of my youth was certainly wasted on me and my beliefs. I fell into this pessimistic belief, this conspiratorial belief. I think it was a wrong belief. And here's why. Since 1950, recessions have lasted between 8 and 18 months, the average about 11 months. So, hey, give these guys credit. They've done a really good job, despite what the purveyors of pessimism have said. And they will always be there crying, well, panic, pessimism, sell, the world's falling apart, the sky is falling in. The pessimists are always there. And they've been wrong. I remember in 1962, I was in a brokerage firm and a couple old guys said, oh, it's going to fall apart. The deficits are so big. Da, da, da. Well, I wish I would have just bought stocks and held on from 1962 forward. Those people that were sat on the sidelines missed an incredible money-making opportunity, not just in 1962, but 72, 82, 92, whenever. The market has been in a very strong uptrend. I think in part, we've got to give some credit to the Federal Reserve System for that. So here's my long-term investing rule number one. If you can't set through an 11-month decline in prices, you shouldn't invest in anything. Now, I've invested in lots of things. I've invested in real estate. Did I have to sit more than 11 months? Yeah. Houses? Yeah. Stocks? Yeah. So, a lot of it is perspective. People get so upset about the day. I'm losing money right here. What do I do? You chill out a little bit. You're going to have recession sometime. There's one coming, but it's not going to be the end of the world that the Cassandras will lead you to believe that it's going to be. So here's some must reading for you. Probably most of you have not read it. It's a Livingston Survey. It was started in 1946 by a newspaper columnist, Joseph Livingston. It's the oldest continuous survey of economists' expectations, and they've done a really good job of predicting the future. They just released their predictions for 2020 and 2021. They have 22 participants in the Livingston Survey, and they nearly doubled their forecast of what they would expect for the end of 2020. The forecasters are surveyed by the Federal Reserve Bank of Philadelphia twice a year. And if you want to get more on this, just go to the Federal Reserve Bank of Philadelphia. You can get the report there. They expect an increase of 18% in real GDP during the second half. We should know that shortly, of 2020. And perhaps more important, they think the annual rate of growth in the second half of 2021 will be 3.7%. They predict lower unemployment rate, and this is huge, as you're going to see. Unemployment is so demonstrative to stock prices. The upcoming year, they see unemployment rate steadily decreasing from 6.7% to 5.5%, still high, but it's the trend of employment that matters, and they predict it's to the downside. So this is the way recessions and stocks really work. The blue line is market peak. That's when the stocks usually peak, and then the cyclical peak in recessions or industrial production is later. It peaks early. Typically, stocks peak before the recession starts, and clearly they bottom before the recession is over. Oh, 2020, what a great example. We've been in a huge bull market. A lot of people sat out to, whoa, we're in a recession. Yeah, we are. But hold on, stocks bottom before the recession does. You cannot use recessions to time stock market bottoms. There's a lot of political bickering, partisan conflict index, though, from the Federal Reserve System. These guys really have some interesting stuff. This is how much bickering is going on in society. Look at that. We're not at an all-time high. We saw that back in 2017. Yeah, the country's really upset about steal the election, not steal the election, whatever. We've seen a lot of political bickering, but it's not as high. It's not as bad as it's been in the past. We got through the past. We'll get through this. What people may not realize is that the Fed is in the prediction business, and they've been good at it. I'd like to show you some of their predictions. Here's their growth prediction for 2021, 2022. Now we see that real GDP growth has gone down, but the prediction is sharply up, about 15% increase in GDP growth, maybe up to 25%. And into 2022, 2023, they all see it back on track and higher. These guys who are pretty intelligent, pretty well informed, are predicting better times coming. If we look at their inflation projection, here it is. We'll look at November 2020. Their inflation projection going out months ahead. So we go out a couple of years, 2 years in advance. Well, we're looking at maybe 2% inflation. So no runaway inflation. And their model has predicted inflation quite well. Now, going out 108 months in the future, we may have more inflation. But currently, where we are, the 12 to 24 months out, not a lot of inflation. That's bullish for stock prices. They also do a business conditions forecast. This is what they're forecasting business conditions will be. And their forecast is a good upturn in business conditions, and a little bit of a tapering off. But basically, good business conditions are coming. Well, here's one of the things I really like to share with you. It's a great indicator for market tops and bottoms. Just the GDP recession indicator rule. When this index gets above 65, you better buy stocks. And when it drops then below 35, it's time, when it gets above 35, above 65, you want to buy stocks, because The recession has really started. It's underway. And that's when the Federal Reserve steps in. When things get really bad, they come in to shore up the economy. Then when stocks start to come down, it's a different, or inflation, recession start to come down, it's a different story. This is one of the reasons why I issued a major buy signal in March of this year. Look where we were. We're at the area where the Fed's going to step in and do everything they can to increase the economy. That was one reason for my major buy signal in March this year. Really clear. When it looks really bad for stock people, it's really good. You can see where we are now. We haven't dropped down well enough, so it looks like we're still in a recession. We probably are. But that's not the point. The point is the great buy signals come when we get into the recession because, as you saw earlier, stocks lead the recession. They bottom before the recession does. Here's another recession index going all the way to 1960. You see the same thing. All these recessions have peaked. They've all ended, right? And they end when they get real high. When they get real high, that's the time when you want to buy stocks. Charles Dickens had this great line. It was the best of times. It was the worst of times. And clearly, 2020 was the worst of times for most people and the best of times for anybody who bought stocks, even in January, but especially March, April of this year. This market's just been relentless to the upside for stock people. We've had a phenomenal year, some phenomenal performance in stocks. It was the worst of times for many, but interestingly enough, for stock people, it was the best of times. So this is what I'm going to be looking at to help me navigate through 2021. First of all, I'm going to be looking at the yield curve. I'll show you that in a moment. We'll get that from StockCharts.com. Unemployment, I think, is going to be critical. And the cessation of COVID bailout before employment picks up, I think this is the real big one right here. As what's holding the economy right now is clearly the government is pumping the economy. They're giving people checks. They're sending out checks for $1,000, $2,000. People are using that money for two things. Interestingly enough, they're paying off debt with that money because we've seen that personal debt has come down, credit card debt has come down, and they're buying stuff. When they buy stuff, people go to work to make the stuff. So that's very bullish. Now, what worries me is if they stop the bailout, the COVID bailout, before employment picks up. So if unemployment is still bad, that's going to be a problem. If people aren't getting jobs and they're not getting money from the Fed, we're going to be in a bind. So I think that's the most critical economic point to watch for this coming year. And deficits, because the Fed is bailing out everybody, we're going to have some huge deficits. What do those mean? Well, this is a typical quotation. This was actually from a congressman recently. Congress continues to spend money that we do not have to bankrupt our children's futures. Oh, I know this phrase. I probably repeated much of it when I ran for the U.S. Senate in Montana way back in the 1970s. Deficits, really bad for people's future. Well, that's a myth. Here's the hardcore reality. Sit down, hold on to your seatbelt. Some of you aren't going to like this, but you better listen to it. It's another one of those things I finally woke up to. Stock returns after budget surplus years, in other words, when we have a surplus in the budget, are about 1.2% after 12 months of having the surplus and 8.8% 3 years later. When we've had big deficits, they're up 16% after 12 months and almost 30% after 3 years. Stocks perform better after deficits than surpluses. I know that doesn't sound right, but I'll tell you why it is correct. If we have deficits, what does that mean? There's a lot of money in circulation. The government is, as Helicopter Ben did when he was at the Fed, just dropping money every place, right? Well, people took that money and they bought stuff, spent stuff. We got everybody to work. And when people are buying stuff, corporations are making money and stock prices rally. So while intellectually we know we ourselves as people cannot have a lot of debt, I don't have any debt, I don't want any debt. In terms of governments, they are dealing with fiat money, not a gold standard. If we were on a gold standard, the deficit would be horrible, but we're not. We're on a fiat currency standard. Will there be a reckoning? I don't know. Those guys back in 1962 said we'd have one shortly. We haven't. My suspicion is we're going to keep the ball rolling. In fact, here's an interesting chart for you. The red line is deficits. And the black line is stock performance. And when deficits are large, that's minus down in this area, stocks tend to rally. And by the same token, when we have lack of deficits, we're real high, we have surpluses, that's when stocks peak out. And that also applies to employment as well. If we have large surpluses, that's the red line being high, we start to have people get unemployed. So there's a causal relationship here, and it's one that flies in the face of what most people think. Okay, the other indicator I'm going to really like to look at this year is going to be the yield curve sell signal. You can see the peak in 2007, 2008. The yield curve was coming down. You can get this at StockCharts.com, by the way. That's where I copied this from. And notice the yield curve was coming down, flat to down. That was then, and that's what same thing happened in 2002. When this yield curve is not in a sharp uptrend, it's coming down. Not healthy for stocks. What's healthy for stocks, see the yield curve coming up, like right here, right now. This is the yield curve through last week, straight up line, very positive. Why is that? Because it says that investors are not frightened, so short-term rates are not appreciably higher than long-term rates. Because if short-term rates are high, a large money is saying, oh, I'm afraid of what's going to happen right here. So they want more interest on their short-term money. Well, we don't have that condition. We have a very bullish yield curve. This is something that could change. So one of those things you want to watch in 2021. The unemployment rate, which I mentioned earlier, this is just huge. The gray lines here are whenever we've had recessions going all the way back to 1950. And notice that unemployment turns up just before every recession. Every single one of them. Unemployment kicks up, kicks up. So I think this is the most critical thing for us to follow is unemployment rates. Now, what's happened now, it kicked up way up, but it started to come down. Can't even really see the scale there very well, can we? So a couple of points we can make. When unemployment gets above 7%, notice the recessions are about over. So that's another anti-index. When unemployment is very high, you want to buy stocks because, again, the Federal Reserve, going back to 1950, will step into the market and do everything it can to save the economy. That is what Congress tells them they have to do. And stocks bottom and stocks rally. Huge. Same thing happened again this year. You can look at stocks and initial jobless claims. That's pretty much the same thing. When jobless claims start to turn up, people losing their jobs, look, where are we? Market peak, turned up. Where are we? Market peak, turned up, market peak. So that's another indicator you can be watching as initial claims. When initial claims are starting to turn up, that could be very negative for stock prices. Well, unemployment right now, I've blown this chart up for us a little bit. It turned up, which would indicate a recession. It started to come down though. Now, I think this is going to be the critical line to watch is, go back to that chart. Do we get an uptick in this line? That's what I'm watching. I don't want to see unemployment turn back to the upside. As I mentioned earlier, if that does, and unemployment turns up, and the government stops the deficit spending and handing out money to save the economy, we're going to be in a real bind because then you have people without jobs, without money. That's going to be an ultimate major sell signal on the stock market. I'm not saying it's going to come, but that's what we have to be on guard for. We look at employment, more jobs, less jobs. We see the same thing from 2008 forward, more jobs. Well, look what happened. We crashed down this year. We started to roll over, but we started to pick back up. We've started to pick up more jobs. And this, even the economy we're in, the rate of increase has started to pick up in here. I think that's positive. So let's look at the other point we talked about, interest rates and stock prices. I think we all realize there's a relationship between interest rates and stock prices. Can we use this, and how do we use this as investors and traders? Well, here's a chart we published a long time ago. The red line is simply interest rates pushed forward. In other words, this low in interest rates was known a couple of years prior to the stock market bottoming. That we should start to rally from this point forward. All these rallies were known in advance by a couple of years. Interest rates typically can help us forecast stock prices a year or so in advance. Here, let me show you another example. This is something that we issued in our March buy signal. I think we may have even had this on StockCharts.com. The blue line is the bond market forecast. Notice it forecasts about 6 months in advance that we should have bottomed and move up. Trend of the market's up. So notice how this is an advanced indicator. What happened in interest rates eventually gets through, works into the economy, and affects stock prices, corporate profits. So we can use interest rates to help us get a pretty good sense of the future where stocks are going. We can do it on a weekly basis. I've done this. I thought you might enjoy looking at this. This is 2021. Our interest rate forecast suggests that we can start to go up. This was the big down that we saw earlier. We should bottom rally up, right in this general period where we've been. We should start to see a rally. And the interest rate perspective for the coming year is positive, as you can see from the blue line. Well, let's talk a little bit about forecast, the ability to forecast. I don't think we can forecast everything, and I certainly don't think there's any magic to it. There's no magic formula. I've been doing an annual forecast report for 16 years now. We have readers in, I think, 60 countries. We nailed all of them? Absolutely not. We nailed a lot of them, though. What we can do is get a general idea of what's going to happen in the future. I don't think anyone can tell us right to the gnat's eyelash when a market's going to go up or down. But if you have a general idea, as they say in the land of the blind, the one-eyed man is king, right? So if we can get a general roadmap to where stocks are going or commodity prices are going, we're way ahead of the crowd because we can be alerted in advance of these things taking place. So the mystery of the future, Jimmy Carter said that the future is very mysterious. I don't think so. Our 2020 forecast report gave a specific trade for the 2020 election. The exact words I wrote were buying the first Monday in November. Could not be more clear, right? There was no hedging to that, just buying the first Monday in November. That was written in 2019 for 2020. Buying the first Monday in November, and there is the first Monday in November. So, hold on. Jimmy Carter was wrong. There's a lot of mystery to the future. I'll give them that. But we can get a decent idea of what's going to happen in the future, at least decent enough for us as traders to use that information to be more profitable in our trading as we come into that time frame. This is the roadmap for a buy or roadmap for a sell. I want to focus my attention. The problem most investors and traders have, they don't have a sense of the future. They look at a chart, it's like a blank thing. They don't know we're going to rally or decline. They might think the company's a good company, but what about right here, right now? They don't know. Well, we can get a good glimpse of the way it's going to look. I have this Jimmy Carter thing, by the way, too. I've done a 2021 forecast report. We've got 15 known advanced trades like the one that we just showed from that one. I've got 15, actually even a few more than that. Trades, you can actually know in advance these trades. That's possible, especially as a short-term trader. Well, here's another thing that drives stock prices, and that's gold. Notice we can forecast out what should take place in the stock market. This was also issued earlier this year. That the blue line is a relationship of crude oil, which is black gold, right? Crude oil is really significant in the world's economy. Most every market in the world highly correlates with gold, with crude oil prices. And we can see that price said we should start to rally, which we've had, and we should start to rally into 2021. So another indication based on crude oil prices. Now, it's interesting. I watch these intermarket relationships. They move around, shift a little bit. Sometimes interest rates are more important. Sometimes crude oil is more important. But they give us a view of the future. And clearly, that's the great view of the future. This is out of a report we did in March. We had a good idea stocks going to rally. You know where stocks are now. They're off the chart. They're way up here. So it was able to help us have a pretty good idea of what should take place in the future. I think life is a lot like the market. It's just a cycle of change. We're always going through change. We're going from overbought to oversold in the market. So I'd like to show you what I think the current cycle is in the Dow Jones Industrial Average. It's about 115 weeks. Notice about every 115 weeks, we've seen rallies start in the marketplace. Here was the 115-week low in 2020, another 115-week low or buying point. Saw it again right here. Well, we've got another one of those coming up in March of this year. So the middle of March, first part of March, I'm going to be alert to a substantial position in the market If you see weakness, you can't be frightened by weakness. You would expect that. And even if we're in an uptrend, as this example, cyclical bullishness comes in here, you want to look to be a buyer. So that's the next intermediate term cycle for you on the long side about first part to middle of March. Also on StockCharts.com, we have our cycle forecast. This is a forecast of the Dow Jones Industrial Average. This is on a daily basis. You can see what the forecast is. It forecasts out about 60 days in advance. So, indication we should market bottom here, start to rally here, rally up here. About now, a little bit of a decline in the marketplace. That's our cycle forecast indicator that is in StockCharts.com. Here it is on a monthly basis for the Dow Jones Industrial Average. Give a little bit broader perspective of where we are. There's 2021 into 2022. Basically, the cyclical trend, the upside for 2021. Here's gold, and we have a lot of people follow the gold market. Here is a cycle forecast for gold. This is really an interesting formula I came up with years ago, maybe 10, 12 years ago. You can apply it to stocks or commodities. It forecast out 66 days in advance. So we should have a low about here, a sell-off about here, a buy about here. Gives a stock or commodity trader investor a pretty good idea of, oh, I want to look to be buying here, buying over here. It helps us understand where the market's going. Another thing can really do that, and it's quite bullish now, right now, is a seasonal forecast for gold. The blue line is our seasonal forecast. It suggests right now, usually in the past, gold has rallied strongly from the end of December into really February. So gold traders would want to be looking to be long gold. I'm long gold myself. I think 30 contracts from down in this area. Why? Well, we saw the cycle forecast, we see the seasonal forecast. So that tells me as a trader, I want to take buy signals. Then I got some buy signals in the gold market. Here's the Apple forecast. Again, this is from our cycle forecast in StockCharts.com. We should see a low here. The market should rally up, pull back, and start another rally. So we can get visibility of the marketplace. Okay, here's the first forecast for you for 2021. This is based on the decennial pattern that was developed by Edgar Lawrence Smith. You take the average of all years ending in 1. That would be 1901, 1911, 1921, 31, 41, 1981, 1991, 2001. Average them all together. This is how most 1 years are traded. Pretty strong until about May, June. Then we start to pull down and have a buy point coming in September. This is a pretty good roadmap by and large. There's better roadmap, but for starting point, this is a really great roadmap for you to start with. And then you can do things like this. So this is my forecast for IBM for last year. The red line and the black line is what actually happened. And here's my forecast of IBM for 2021. The blue line is a fundamental forecast for where I think this market is going on a longer term basis. And you can see where we have the buy points based on cycles right there. We can get that much visibility into the marketplace. Isn't that great to have that, to know what's going to happen, get a good sense of the future? In my forecast this year, I'll talk about the GAN master forecast and my cowboy cycle, the best fit pattern. There's one pattern, the market's followed this pattern for about 20 years now. I think it's important. We have forecast roadmaps for all major commodities and select stocks for golds, bonds, all the major commodities, plus roadmaps for Apple, Costco, IBM, most all the major stocks as well. If you want to read more about my forecast 2021, go to ireallytrade.com/forecasting and read about the 2021 forecast. And above all, I want to wish all of you a most prosperous and new year. I don't think we have bad times coming. I think we have good times coming. What we'll want to do is watch this data from the Federal Reserve System to see if there's a change. But for now, I look forward to 2021 and wish you a most prosperous new year.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.